Now, one of the things students often ask is, why do we study all this statistics and starting to sound a little bit like an investment class instead of a corporate finance class and all that kind of thing. As a financial manager of a corporation now, you maintain, you run, you determine the portfolio of the corporation. The portfolio of the corporation now are the assets on the balance sheet of the corporation. What you want to do in a normative sense, the way things should be done now, in a normative sense now, you want to combine assets on the balance sheet of the corporation that'll give you the most return for the least amount of risk. You want to be a rational investor. A lot of corporate theory now comes from investments. You want to put the assets on the balance sheet that'll give you the most return for the least amount of risk. That will maximize the value of the firm, the wealth of the shareholder, and the price of the stock in the market. And as a financial manager now, that's your job. So though this all sounds a little bit like investments, we're really talking about a portfolio here. And the portfolio of a corporation are the assets on the balance sheet. Now, let's say that you had your portfolio, your corporation, the assets on your balance sheet now look like this graph up here. This is your portfolio, this is Corporation P up here. And note, over time now, these asset returns go up and down. And on the mean now of your mean return for the assets on a balance sheet in your corporation is 9%. You go out as a corporate officer, you go out and you look for new assets. And you want to find assets now that are going to do what? Combine with your assets, what's already there, to provide you with the most return for the least amount of risk. And you find asset I over here, and you're looking at possibly putting that asset onto the balance sheet of the corporation, or in an investment concept, an asset you think about bringing into your portfolio. And you chart its returns over time. And its returns also go up and down. And it also has a mean return of 9%. Now these two assets, if I could draw it up correctly now, these two assets would be what is known as perfectly negatively correlated. That means the correlation statistic between the portfolio and asset I would be -1. Perfect negative correlation. What that means is that when your asset returns are going up, this asset's returns are going down at the same time. And when this one reaches a peak, this one reaches a trough. When your asset returns are going down, this one's assets returns are going up at the same time. When it reaches a trough here, you're reaching a peak there. The other thing this means now is that the area under the curve here is equal to the area under the curve there. So if these positive deviations sum to 25% positive, these deviations here, these negative deviations, would sum to a negative 25%. And if these negative deviations here sum to -15, then these positive deviations here would sum to a positive 15%. What's called perfect negative correlation, okay? When one's going up, the other's going down at the same time now, okay? If you had perfect negative correlation, and you could find that, which by the way, you can't, but if you could, if you combine those two assets now, the new corporation, your new portfolio, its returns would look like this, a straight line. You get to keep the high 9% return, but at any point in time, the return you expect in the next time period is the mean of the distribution. That means you've created a risk-free asset. That's a good thing. You want the most return for the least amount of risk. Now, you can't find negative correlation like this. It would be easy, it would be a good thing if it were possible, but it's not. But theoretically, and we're in college here, we're talking about perfect negative correlation. And if you had two assets with perfect negative correlation and you put them together, you would create a risk-free asset. The reason all of this is important, and this is portfolio theory now, the reason this is important now is you want to find assets that have negative correlations or low positive correlations, because when you combine the assets, you get to keep these risky returns. Creating a less risky asset, or in this case a risk-free asset, doesn't drive your return down to the return of a treasury bill or something. You get to keep the risky return. So portfolio theory is important in investments and is important in corporate finance, because if you find good assets to add to your portfolio, you're going to get to keep the return that you're getting off those risky assets, but you're going to reduce the risk. So you're going to end up getting more return for less risk. And that's why portfolio theory is not only important to investment people, it's also important in corporate finance. If you're managing a portfolio in corporate America, the portfolio that you're managing is the assets on the balance sheet. And you want to combine assets in such a way that you get the most return for the least amount of risk.